Hi everyone, I'm Brandon Averill, one of the partners at AWM, where we advise people in creating multi-generational flourishing families so that we can solve that shirt sleeves to shirt sleeves financial epidemic. And this is a front row seat with AWM's Chief Investment Officer, Justin Dyer, and myself, as we discuss some of our clients' most pressing financial questions. This is AWM Insights, and let's dive right in. Well, Justin, welcome back. We're splitting up in offices again. We got a little teaser when we come to you next week. Hopefully we can figure out, a bunch of finance guys figuring out a soundboard and some lighting. But not to digress, last week we jumped in. We talked about the private markets a little bit, really hit on when private markets become available or should become available to you as the investor, and why you should actually be interested and why you would want to participate. So kind of laying that foundation, we wanted to get in and start talking a little bit more tangibly about, okay, we talked about the private markets extremely broadly. Let's start to define a little bit, some different ways that you could actually participate in the private markets. And we'll start high level here today, and then in the coming weeks, I think we're going to try to take some deep dives into these different sections. But for today, Justin, why don't we just start to define, if you don't mind, what are the different areas that we can participate in the private markets?
Yeah, I'll jump right into it, and like you said, we'll build on this in the coming weeks and try not to nerd out too much, but. Let's start with venture. I think we focused a lot on that in the first conversation we had, and that is a favorable part of the private markets that we have. And just as a refresher, the reason being there that the highest expected returns or the highest proven returns have been there, and the highest expected returns going forward still largely exist in the venture capital space. So let's define it. Venture capital, really quite simply, it's a subset of private equity. So private markets, let's start high level. Private markets, we've kind of defined that. These are non-publicly traded entities, securities, companies, et cetera, et cetera. Private equity is the equity side of the balance sheet, meaning you actually have an ownership stake in a company. Private debt, on the other hand, is exactly what it says. That you own debt on a privately backed company or privately held company. Venture is a further subset, like I said, where really what's going on there, you could think about it. You're taking an adventure in a sense, and really backing new ideas, backing unproven ideas, new business models where they're trying to disrupt potentially an existing market or an existing industry, or create a new one essentially from scratch based on some new technology, some new idea, et cetera, et cetera. Within venture, you'll hear all sorts of, or you've heard, you might be familiar with the different stages of raising capital. So there's angel investing, there's pre-seed, there's bridge round, seed round, series A, B, C, D, E, et cetera, et cetera. The simplest way to think about that is those line up with the maturation of a company. Not all companies have every single one of those funding rounds, but essentially they line up with the maturation of a company. And when a company's starting, they're going to be on the earlier stage. So pre-seed, maybe they have some angel investors to help them get started, or they just went directly to a seed round. The later, more mature companies, maybe they have a proven business model, slightly profitable, or a very realistic, close time frame to get profitable. They're going to be raising something like a Series D, Series C, D, E, et cetera, type round of financing to hopefully bridge that gap to get them to some sort of liquidity event, an IPO, maybe it's an acquisition from an existing player, et cetera, et cetera. So that's private equity. Brandon, you want to go into the debt side of things a little bit?
Yeah, I think so. The debt side, probably a little less common. I mean, you see a lot of like later stage private debt. You think about this, like, we have a lot of athletes, and unfortunately that predatory kind of hard money lending is a good way to think about it. And so you'll have private debt where you have a private company and maybe they can't access, the big bank market. And so there'll be opportunities to actually lend money on this side. It could show up on, in real estate, it could show up for a company. But it also shows up in venture. So what you just talked about, Justin, you have a company that's just starting up. A lot of times or sometimes you will actually have a venture debt firm partner up with a venture capital firm. So the venture capital firm's buying equity, so ownership in that company, whereas the venture debt firm is typically coming in and lending money to that company. And there's something typically attached to that, including called warrants. We'll get into that in the future. But at a very high level, it's going into those private companies and lending money to them.
And maybe it's a good time to put some actual tangible examples here. There's a big topic in the news right now with Twitter and Elon Musk trying to take Twitter private. And that private term that you're seeing in the news is exactly what we're talking about here. Essentially, Twitter, let's go through the life cycle. Twitter was a venture-backed company. Early on, it grew, it matured. The owners of Twitter decided to take it public, to take some chips off the table. There's pros and cons to going public, which we can potentially talk about maybe at the end of this whole series. But essentially, Twitter started as a venture company, went public. Now Elon Musk is making a bid to take it private. It's not the traditional private equity side of it. So again, private venture being a subset of private equity just being a private party or a set of private parties owning a company as opposed to it being listed on the public stock exchanges. And so this Elon Musk bid is not necessarily the traditional, it's not a big private equity group that's coming in to try and take Twitter public. It's essentially a single guy. Now, in all reality, he's got a lot of financial backing. It seems like he's still trying to put together his whole financing package, but he's got some big banks that are coming to the table to give him some loans, and he needs to come up with the equity side. So a big difference between venture and private equity in the traditional sense is, I'd go back to this stage definition, the stage analogy, the life cycle, the maturity of the company. Twitter is a mature, publicly traded company. It has profitability. And what Elon Musk is trying to do is trying to improve the overall makeup, the overall financial situation of Twitter through a combination of things, his pure raw brains and brawn, if you will, but also traditionally, and this will be yet to be seen if Twitter is a perfect example of this, what private equity traditionally does as well is put debt on the books of the company and try and, through some sort of financial engineering or financial leverage, improve their potential returns from that transaction. I know that's a little into the weeds there, but it's a big difference between venture and private equity. Venture, again, kind of new idea, new market, new company, new business model, trying to disrupt things. Whereas private equity is probably generally taking a more mature business model in an existing industry that can be improved. Efficiencies can be brought to the table, whether that just be through financial structure, bringing debt on, or through rebuilding the operations from scratch, essentially. So hopefully that's the private equity side. Maybe we get into the real estate side now, or if you have anything else to say on private equity.
One quick thing is just, I think it's really great to think about the different, the maturation of the company, but just to be clear, that doesn't always mean size. So, venture-backed companies, typically, you are investing in an idea, you're investing in something that is going to grow big. That's the idea. In fact, I looked it up before the podcast, but there's a paper that Jay Ritter at the University of Florida wrote, and it's, 40% of publicly traded companies, since 1980 have actually been venture-backed. And since 2000, more than 50%. So you're investing early and you're hoping for a big outsized return. Whereas on the private equity side, that could be the case. I mean, they could be multi-billion-dollar companies, but it also could be the regional hardware store that's been in business for, 75 years, maybe family run, and a private equity, group may come in and see those efficiencies, Justin, you talked about. Maybe they can improve operations, logistics, supply chain, etc. And maybe they're looking at it and maybe it's a $20 million revenue company and they're going to invest $5-10 million and operationalize it. So, just to be clear, it's not always the size of the company, but that is a more mature business model, as you were pointing out there, Justin.
Yeah, that's a great point.
Yeah. So, and then kind of moving on to real estate, I think a lot of people think about real estate in the private sense. There is a public side of real estate as well that I think often gets ignored, but, real estate, the world, is massive on the private side. You've got what a lot of people, again, I think of when they think of private real estate, those single family homes, a fix and flip. We're going to buy, 20 homes and rent them out. When we talk to our clients, unfortunately, the evidence shows that's just not typically the most successful way to go about private real estate investing. Is juice just really isn't worth the squeeze, and you're competing against a lot of people. But then as you start to move on from there, right, it's multifamily, so apartment complexes, and these could be any size. It could be a five unit building up to, several hundred units, just depending on where you're at and price standpoint. And then you've got commercial. So think about your strip malls, your big Kmart. Is Kmart even still around? I'm dating myself, but Kmart shopping center. I don't know why I think about that. Walmart. And then, you've got your kind of more industrial. So think like Amazon warehouses, et cetera. All ways to participate in the private markets. And I'm only touching the surface there, but I'm sure, Justin, you could probably take us a little further.
Yeah, I mean, the real estate market truly is vast. And there's also different stages within that, this part of the market as well. So, we're touching the surface on various types, whether it's commercial, residential, industrial, et cetera, et cetera. But you can also think about it as, similar to venture in a sense, the stage of that asset. Maybe it's just a hole in the ground, or maybe it's just a piece of raw land and it needs to be developed. Maybe it can potentially be farmland. We didn't even touch on that as a part of a even further subset within real estate, which is, an interesting one as well. But just briefly on the stages, and there's different things to think about with respect to the stage. So raw land or developable land, right? That's attractive from a pure capital appreciation standpoint. You're likely going to buy the land, build a building, build a multifamily, whatever it is. Maybe it's a commercial building, and then likely sell it to somebody who is looking for a more income oriented real estate asset. So the development is more of a capital appreciation. You put money into it, and then hopefully sell it for more than you put into it. And that's a capital gain type situation versus a more stabilized asset that is, maybe it's an office tower or an office building that is 90% occupied, something like that, just kicking off nice recurring income from the tenants. And that could be what all an investor wants. They don't care so much about the capital appreciation side. They're making an investment for income. Just quick teaser. One reason why we generally don't go after pure income plays with real estate is that income is also taxed at your ordinary income rates. And so if you're in the highest tax bracket, which most of our clients are, you're giving up a decent amount of your return if a lot of it's coming from the income side of the appreciation equation. So a little teaser there. We'll get into that more and more. But then there's also, hey, you can buy a building that needs some improvements. It's already been built, but it's been run down, poorly managed, or it's in a up and coming part of a city or town or whatever the case may be. And then there's somewhat of a combination play there where you're buying it and you're going to add value through improvements, but you also have some sort of current income to offset it. So real high level, those are just ways to think about real estate in terms of stages and what may or may not be good fit given certain client profiles and goals.
Oh, I think that's great, Justin. And I think, one last thing to mention before we close out today is, and we're going to take a deep dive here, but the big difference here too in the private markets is the onus on you to do the due diligence. And I think that's a key point. The public markets, information's efficient. It's available to everybody. There's tons of regulation. And so, it's a little bit easier, right? You can offload a lot of that to other people. In the private markets, I think it's good to note, like, a lot of the work is on you and your advisors. If your advisor's not willing to kind of dig in with you, that potentially you're up against an uphill battle, in the private markets. And so, you have to really dig in and understand this stuff. If you're being approached with a private real estate deal or a private equity or a venture deal, and you don't have an advisory team that's digging into it, and you're not willing to, read through the reports, request the data room, really try to understand it all, none of this stuff is very simple. And so we just throw out a word of caution, and hopefully over the next few weeks, we're giving you some tools to be able to do the due diligence on these projects and participate if your financial structure allows for it. Because as we said, it is the place that you have the highest expected returns. And so if you've done a good job putting your financial structure in place, this is a place that you should want to participate potentially. But it's ripe with risk as well. So we look forward to hopefully guiding you through the next few weeks. We're going to dig into venture capital first. Really kind of frame that for you. How are the different ways you could participate? What are the things you need to ask? All that good stuff. And it's something we're passionate about. So we hope you enjoy taking this journey with us. If you have any upfront questions, by all means, shoot me a text. As you guys know, that text comes directly to me. The phone number is 602-704-5574. You can throw insights in that initial message or the little light bulb emoji. Throw me your question. We'll get to it on the podcast. We would love to answer your questions directly. Again, that number is 602-704-5574. And until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.